Welcome to the December 16th Audit and Risk Committee Advisory Committee meeting. I'd like to call the meeting to order. Is there any disclosures of pecuniary interest? Seeing none, we'll move on. Approval of the agenda. I'd like to get someone to make a motion to approve the agenda.
Here.
Councillor McHugh.
I'll second it.
Seconded by Mr. Sanford. Thank you. All in favor?
All in favor.
Pass. That the minutes of May 6, 2024 Audit and Risk Advisory Committee meeting be approved. Motion by Councillor Quinte.
Second.
Seconded by Mr. Browley. All approve? Approved, thank you. Public input. No public input. Next, delegations presentations. Jeff Lay will do a presentation on the 2024 audit plan.
Not used to being here when I'm the only person here. So once again, I just wanted to thank you on behalf of Wilkinson & Company for appointing us as your auditors for the year. Not a lot has changed from the audit plan in terms of prior years, so if you've heard my presentation in prior years, it'll be fairly similar to what this year's presentation is. One of the main parts of the audit is that we remain independent. We consider ourselves to be independent. Nothing has come up that we are aware of that would make us question whether or not we're independent and able to carry out the audit. However, I always ask because there's actually being independent, and then there's perception. The perception of independence is always harder to establish. It's what things you don't know, other people's perception. We're not aware of anything. We haven't heard of any rumors, anything out in the community that would indicate that there is a concern, but I would ask the Audit and Risk Committee that if there is anything that you've heard that makes you question our independence, please bring it forward before we start the audit. It's always easier to deal with things like that. Meet them head on than it is to find out after the fact that there is a concern that somebody has. So once again, we're not aware of anything, but if there was anything, I'd ask, it could either be directed directly to me, it could go through Caleb, who could pass the information on, but if there was anything, we just ask that it be indicated to us. Similar to prior years, this is a risk-based audit that requires us to obtain a knowledge and understanding of your internal systems and controls, focusing the testing on areas where there is more likely to be a material error, designing procedures and testing of those areas. Materiality based on preliminary information has been set at the same as last year, which is $750,000. That may be adjusted when we get the information, I'll say the initial draft of the trial balance. I like doing presentations like this for organizations like yours because you have a qualified audit or internal accounting department. You prepare your own financial statements, your own notes. You implement, design your own internal controls. We get to come in and do a true audit. We provide the opinion on the financial statements, but they are truly your financial statements, your notes. A lot of organizations where we do audits, they're sort of partial. We help a lot more with the design of the notes. It's obviously the client's final decision on the notes and the content, but you have a very knowledgeable staff internally of accountants that make this it's a fun audit to do because there's discussion back and forth every year on new policies and new accounting pronouncements that come out, what information is needed to have in the statements and in the notes regarding those. So it's challenging from that way, but it's nice to actually have those conversations with other accountants. On that note, there are 2 new standards this year that will be relevant for the city. They were mentioned last year, but it's PS 3400, which is a new revenue standard. Just on revenue recognition, the example of what the new policy requires, if you sold a parking space to somebody for 6 months and they paid on day 1, you now have to recognize the revenue over 6 months. It just more closely aligns the accounting standards for public service bodies like yours with the regular accounting standards. The other new standard is PS 3160, which is public-private enterprises or partnerships. That's where you would, if you think of the Highway 407, the government contracted with someone to build it, they entered into a partnership with them, and it's how you deal with revenue recognition and recognizing those types of infrastructure partnerships. So if there were partnerships with private enterprises for infrastructure, that could be hit by the new standard, and it's just disclosure and what has to be treated. I'm not aware of any of those partnerships in the new year. I know when we spoke last year, there weren't any, so it's just if there's been anything new in the current year.
There's always hope.
I guess if it helps with the infrastructure, yeah. The audit team this year is similar to last year's team. It's myself, John Tour as a secondary quality control partner. Rachel Lidstone's one of our audit managers. Isabella Rapino is one of our senior staff. And then there'll be the odd co-op student coming out to get some initial testing done. Timelines are end of March, starting the audit, with early May having the draft financial statements. Interim testing probably early January, with some flexibility on our end in terms of timing based on your needs. If there's delays or if things are ready early, we can start earlier. Then at the end of the audit, I'll be back to do an audit findings report, which is basically this presentation with any information that came up during the audit. Any issues or any concerns that we had during the audit would be presented to this committee. And that was it, unless there's any questions.
Any questions from anyone here? I have a couple.
Sure.
The first, I see that the audit services are going to be up and we're going to be going for new quotes this year. And I'm happy we're using a local firm that does a lot for the area. Maybe you can explain how the process is going to work for that and when it's going to go out for quotes.
Through you, Chair, that we have a purchasing policy on how we go out for tender on this kind of thing. So, unfortunately, there's no way to have a local bias, I guess you'd say, according to the purchasing policy. So we'll go out to tender and we'll do it in an open, transparent way.
Yeah, but when it goes to open tender, if we get a firm from outside of the area, do we factor in they're going to charge meals, they're going to charge mileage? Do we factor that into the quote?
Yeah, every organization that quotes some of those numbers, so those numbers are factored in, I guess, yep.
Okay. And Jeff, with materiality, for example, could you give a definition of that? And let's say, for example, your example of the 6 months parking fees.
Yep.
Now, we may not record all 6 months over 6 months, and if it's only $500, we'll record it as soon as we get it.
Yep.
So how would you treat that?
So materiality, typically, that's $750,000. It's established, there's benchmarks that the auditors will establish that are sort of industry standard, and it's the number by which you can have an item not adjusted and it wouldn't impact the user's decision on the financial statements. So the example of the parking pass, if there was $1,000 paid that should have been stretched out over a 6-month period, and that period overlapped the end of the year, and Caleb and Matt didn't want to do that, they just wanted to recognize the full $1,000, we would look at it, if we saw that one and say, well, you should have only recognized a portion of it, the rest should have been for next year, it would go on a list of unadjusted differences, which we do present to you at the end of the audit. So you could see all of these items that we felt should have been adjusted, that your internal accounting didn't want to. As long as the list of those items doesn't exceed $750,000, it means we can issue the audit opinion, and those adjustments can be done next year. Historically, there have not been very many. Most of the time, if we come across something that's an error, typically internal accounting wants to adjust it. If it's agreed, if we found a $500,000 error, typically it would be adjusted because everybody wants the statements to be accurate. There's times where there's something's off by 10,000 here. One day got missed on an accrual, and it's going to fix itself on literally the first day of the next year. As long as it's not in aggregate all of those items more than 750, it means we can issue the statements. you wouldn't have, the users wouldn't make a different opinion or decision based on those statements, knowing that that error was there.
Great.
It's impossible to audit 100% of everything, so it's a recognition that there may be some things that are wrong. You know, if I told you there was $10 in your bank account and it was really $9.50, would you really care? If I told you there was $10 and it was really zero, you would care. So it's that gray area where it's not really going to change someone's decision.
That's great. Thank you for that explanation, and thanks for your presentation.
Okay, thank you. Is that it? Okay. Perfect. Thank you.
Thanks, Jeff.
The second presentation, Hector Placenciana, committee with the final report for Phase 1 of the actuarial analysis project. I believe Hector's online, yes.
Hi, everyone. Can you hear me?
Yes, we can, thanks.
Perfect, thank you. Yeah, there's also my colleague Eric Sater on the line, so perfect. So Eric will be sharing his screen, but basically, as you mentioned, thanks for having us today with you. We'll be presenting basically the overall results of the actuarial analysis that was conducted for your general liability and errors and omissions insurance policy. Basically, as part of this engagement, the key objectives that were kind of like set out for the entire exercise were to help the city understand the overall value proposition of insurance, but also optimize that structure on the basis of what makes the most sense from a numbers perspective. So basically looking at different components of your insurance program, as well as the underlying risk exposure associated with your risk profile, so that we can help you basically maximize the value of your insurance program. So the 4 points of focus as shown on the screen basically is to understand what is the best modeling methodology that would help the organization understand what is the total risk exposure that you're subject to on an annual basis. So we look at basically historical losses, what the past basically tells us about the future. We also look at the specific components of your risk profile that are mapped out against also an underlying exposure that maybe is not captured by historical losses. And then based on both historical losses as well as your exposure, we basically create a projection moving forward as to what is going to be the expected losses for the coming year. And then once we have that loss distribution, we basically map it out against your insurance program, deductibles and limits, so that we can basically help you understand whether or not the current insurance limit, for example, provides appropriate coverage for your underlying risk exposure. And then we do the same thing for your deductible layers. And as part of that evaluation from limits as well as deductibles applicable to the program, we also evaluate basically the premium credits that would be potentially achievable by looking at alternative structures. So by adjusting, technically in this case, the deductibles that would be subject to in the policy. That way, then technically we can provide you with an additional input as to what is the most efficient total cost of risk value proposition that insurance would provide you, and whether or not the insurance market would provide you enough credits associated with the changes to your policy. After that, then basically we'll provide you with recommendations as to whether or not you should actually take the credits and increase your risk retention. And then it's up to the city to actually decide whether or not that aligns with the overall value proposition that you see in the insurance program, based on the objectives that you have with respect to the reduction in total cost of risk, but also the due diligence that you have from a perspective and level of comfort that you have with respect to risk management. So without further ado, I'll pass it on to Eric to give you a walk through the entire analysis and the key takeaways of the exercise.
Perfect. Thank you, Hector. So to kind of summarize as well, before I jump into it, the current status of the insurance program at Quinte West. So for these two lines of insurance, they're combined under a single insurance policy, and they have currently a $100,000 deductible, followed by a $9.9 million, $10 million primary limit, followed by another $40 million of excess insurance. So currently the organization retains $100,000 of any loss, and then is covered up to $50 million for any singular event that could hit its balance sheet, or to prevent it from hitting its balance sheet. So this is kind of the executive summary, the way that we organize these reports as we start from a very wide view, and then we'll funnel down on each of these elements and walk you through the takeaways from this modeling process. So we started with the model construction. So we looked at the historical performance of the city, we looked at industry data, and we looked at possible catastrophic scenarios that we've seen in the industry. And we used all these different methodologies to create a model that we identify as a moderate to high conservative model. That is to say, it's more conservative than less, to ensure that we took all these potential factors in place and to ensure that Quinte West can be comfortable with the outputs of this analysis. So again, throughout the modeling, we looked at the historical losses of the city. We looked at industry losses that were specifically informed by Quinte West's core services. So we didn't look at losses that were linked to types of services that aren't offered by the city. We looked at catastrophic loss scenarios. So what are a worst case scenario that could affect the city, the wastewater treatment plant, for example? And then what is the actuarial pricing by layer? So how can we look at how losses are distributed at the primary layer in your first 5 million, your first 10 million, your first 20 million, and what that means for the organization? So again, the final model that we selected was that moderate to high conservative model, which is model 4, which estimates that a 1 in 100 year loss scenario is that the city would be faced with $3.4 million of losses, most of that being captured by the insurance market. And then again, in a 1 in 1,000 year loss scenario, so the 99.9th percentile, what we would see is approximately a $16 million loss, which again would be mostly captured by your insurance policy. So that's essentially the high level ground up losses, what we're looking at, what could impact the city, absence of insurance. When looking at the current insurance policy, the current deductible, the exceedance probability would estimate it at 32.7%. What that means from a high level, it means that we can expect 2 years out of 3 that you're going to be transferring some losses to the insurance market. The consequence of that is essentially that by knowing and by being able to predict that there will be a significant amount or some losses transferred to the insurance market, when the insurance market prices your policy, they take that into account. And so you're essentially being charged $1.50 for every dollar of claims that you can be expected to receive. That's what we call a dollar trading relationship. So on that point, the deductible was considered that the current retention level is adequate, but it is conservative, and there could be potential value in increasing the amount of risk that the city takes on. From a quantitative standpoint, and we'll get into the math in a little bit, but increasing the deductible from $100,000 to $250,000 would reduce the cost of risk of the city by about $54,000. So taking into account that you would be retaining additional risk, on top of that, the reduction in premium is great enough that you would still be saving an additional $54,000 a year, taking into account even with the fact that you would be paying additional losses. So again, these indications to us bring us to recommend that the city should consider increasing its deductible to $250,000. When looking at the insurance limit piece, the current limit of insurance covers up to the 99.99th percentile, which is the highest percentile that was modeled and is a 1 in 10,000 year event. That means that the current structure is very, very conservative. However, that doesn't mean that it makes sense to reduce the limit of insurance. The reason why is because even when looking at these conservative insurance limits, assuming that this materialized, the city still has favorable pricing compared to the market. So again, because the price of those excess layers, those two $20 million layers that get you up to the 50 million, is so low compared to the consequence of actually suffering that loss, we see there as being value not only from an insurance perspective, but from a risk capital perspective, essentially as a way to have access to capital in the case of an event like this. Finally, from a technical pricing perspective, overall, Quinte's current insurance market pricing is considered underpriced. So you're actually getting a good price in the market. However, that's mostly driven again by those excess layers So looking at the expected losses in those two $20 million layers, excess of the market. When looking at the primary, we would consider it to be generally fairly priced. You're actually slightly underpriced, so you're getting a quite good deal in the market. However, that doesn't mean that there's not value in the premium increase, or the premium credits, sorry, from a deductible increase. Doing so would indeed reduce your total cost of risk, as we said, by $54,000. So overall, your key conclusions: the current insurance limit is adequate but conservative. However, given that you're getting a very good price in the market, we would still recommend to maintain the current limit of insurance. Second, Quinte West current insurance pricing in the market is favorable, so you're getting a good deal in the market overall. However, step 3, there could be a benefit in increasing the current retention level to $250,000, and that is our recommendation, given the premium credits that you'll be receiving in exchange for that increased retention. So that's essentially the high-level summary, and I'm going to dive into more specifics throughout, but are there any questions at this point on the high-level conclusions of the report?
Any questions?
There must be at least one.
I have one. Some companies are going to self-insure themselves, consolidating with different companies like trucking companies. Should Quinte West be considering this type of self-insurance, going with other municipalities for a portion of the insurance? Have you considered
That's a
that?
very good question. So in the current scope of work, so that was not included in the current scope of work. That being said, we see some organizations choose to do that. Hector can maybe talk a little bit more about the reciprocal aspect, because that's a specific type of vehicle that we often see with municipalities. But we have seen municipalities kind of pool their risks, and there's a lot of different ways to do that. Hector, I don't know if you want to add.
Yeah, so generally speaking, I would say that it really depends also on the level of comfort that you have with your risk and what you want to accomplish from an aggregate reduction in total cost of risk, because generally speaking, the reason why companies would go towards a group buy kind of like structure is also because they see that as a potential lever for negotiation also with insurance market that cannot be accomplished individually. But it also opens the door to other considerations, right? Understanding who are the members that are going to be participating in that risk financing structure that is more on a group structure basis that is not necessarily subject to the same constraints or level of control that you would have by having your own insurance program. It is an evaluation. However, I think it's a due diligence exercise that would actually provide you with additional guidance as to whether or not that actually makes sense. But there's considerations from a control perspective that would also have to be taken into account. If you consider that self-insurance is something that you would like to explore more proactively, you can still technically look at that from an increased risk retention via the deductible technically. But as Eric mentioned, technically, like the value of insurance is provided more on a catastrophic perspective. And the analysis seems to indicate that you actually are receiving a good deal in the marketplace. So in the absence of those indicators, I would say that the reasons for looking at a group buy structure would be stronger, but you still have options technically to increase, for example, your current deductible from $100,000 to $1 million and gain more control without necessarily going or exploring into a structure that shares risk with other parties, and that would still qualify as self-insurance.
Okay, thank you. Councillor Quinte?
Thanks very much for your presentation. So I do have an insurance background, and I find it amazing that there wasn't more questions. So you were talking about levels of limits. I wrote down, the first thing you mentioned was a $9 to $10 million limit, and then you mentioned a $40 million limit, and then later on, Eric mentioned something about 2 layers of $20 million each.
Yes.
So what are we talking about there?
So to kind of to rephrase it, so essentially you have a $100,000 deductible for a $10 million primary policy.
Okay.
And then after that, you have 2 excess layers, each of $20 million, which together make up $40 million. And so when you add up that $10 million layer with a $20 million layer and another $20 million layer, you get a total insurance tower of $50 million.
So you're describing an umbrella policy. Is that what we're doing?
In this case, it's an excess policy, so it's specific, I
excess.
believe, for GL and E&O.
And are these,
I believe. Go ahead.
are these on buildings or just liability alone?
So this analysis exclusively looked at general liability and errors and omissions. There will be, as part of the process, there's going to be another analysis done in 2025 and in 2026 that are going to be looking at property and auto liability respectively. But this specific recommendation exclusively looks at your general liability and your errors and omissions coverage, because that's one policy within itself.
What's an example of a municipality of our budgeted amount and population of an incident that's occurred in Canada where $50 million was either reached or exceeded in a claim situation?
I would have to verify internally as to our ability to reveal specific information.
I'm not asking for specific information. I was just asking for an example.
So it would be cases around things like water treatment plant, severe incidences around water treatment plant failures, where there's a significant amount of essentially sewage doing property damage across the city. That's generally what we're going to see as a general liability exposure for the city of Quinte West's size and operations.
So with our investment in our water treatment program and the excellent reports that our water treatment program has received over many years, and plans and investments in training and equipment to keep our staff on top of what's the potable water going out, and the staff we have, investment and upgrades that we're making in our wastewater treatment facility and our lines leading to the wastewater treatment plant. These limits do seem really on the high side to me. I'm just giving my opinion on what we're trying to do as a municipality, and then what you're trying to tell us in regards to these layers of liability and in errors and omissions. I just get the opinion that this is a little on the excessive side. That's just my opinion.
Yes,
For what we're trying to do.
There's two considerations with respect to this. So the first one is that the preventative nature of everything that you do already to control the risk might give you actually more comfort, as you mentioned, with respect to the limit that you actually purchase in its totality. It doesn't remove the possibility of something actually happening and reaching that amount, because in reality, there's also like certain things that the city cannot control, failures that are completely unexpected and might actually lead to a similar loss of that magnitude. And then the second component, as we mentioned, was that there is a component of the capital at risk, where it might make sense to actually keep the insurance tower as it is, just based on the value proposition that the insurance market is providing you from a total cost of risk perspective. So the underlying risk exposure versus the premium that you're being charged. And technically the trade-off that you have by taking the risk with a low probability, for sure, a low probability type of event, but that financing the risk via the insurance market is probably the most effective way of doing it, rather than using your own balance sheet to do that.
And then I had
But it's a question again of risk appetite at the end of the day. So if you believe that your preventive measures and mitigation measures and everything that you do already, it's actually good enough and you're comfortable with that, then the question it's definitely whether or not it's a good decision, a duly decision to actually reduce the limit of insurance.
Yeah, and then I got another point. You mentioned about our pricing that we're getting, and we're just speaking specifically on our errors and omissions and our liability policies that you are talking to us here today. That
Exactly.
it's tough for us to see whether we're getting a really good price or not. Like, we don't have a clue. Your agency is recommending that the markets that we're using And you've been servicing our city for quite a number of years, so like we're really getting to know each other really well. Plus, your brokerage is offering great services to our city to help with training in all kinds of areas and not just liability areas. Trucking and driving vehicles and our IT department and that sort of stuff to make us a better risk to the insurance companies and better for our staff because they don't want to be panicking every time the phone rings thinking that, oh my Lord, what's happening now? Because we don't want that either. But it's just tough for us to see when you're talking about pricing that we're getting a better than average price. Like how would we know? Like we're not shopping our insurance.
So just to clarify, so part of there's two components in there that you mentioned. So the first one is that when we talk about pricing, we're talking about the pricing from an actuarial perspective compared to what you're getting in the marketplace. So the actuarial estimate provides you with an estimate from a pure intrinsic value perspective, so value at risk, compared to what the insurance market is providing you. Then on an annual basis, PFL and the broking team, which is a separate team from us, they basically look at a marketing exercise to validate still that you're getting a good pricing in the marketplace. So that component is technically independent and is conducted annually to ensure that you're still getting a good deal by looking at what conditions have changed in the marketplace and what insurers are willing to price your risk for what level, and then put basically the current insurers in your program in competition with other insurers for your risk exposure. So the two elements that we're talking about, technically one of them is a marketing exercise that is conducted by the broking insurance team. And then this exercise that we use from an actuarial perspective, where we're comparing basically what the market is providing you as feedback compared to what an actuarial modeling and the intrinsic value of your risk exposure like represents as a pricing.
Right. Well, I was just pointing that out from our point of view, and thank you very much for your answer. Like I said before, your brokerage has offered great service, and we've been working with you for quite a number of years. I don't remember exactly, but pretty sure it's over 5 years. Am I not correct? Yeah, okay, thanks.
Yeah, I believe so.
I'll let you, unless there's other questions, I'm going to let you go on.
Okay, thank you. Further to Councillor Kunce's questions, with regard to the maximum coverage, it's my understanding if we have like $10 million coverage and increase it to 20, the premiums for the additional coverage are usually a lot less, factoring in the probabilities of that, correct? Thanks.
Exactly, yeah.
Councillor Siddell, what
That's
questions?
fine.
Yeah, thank you, Mr. Chair. So following with some of the information that's on the screen, you're saying that if we went to $100,000 to $250,000 deductible, we would save $54K, but in the council report, it says that the savings is about $106,000, I believe.
Yes. So if it helps potentially, the $54,000 is taking into account that you would be paying additional losses. So that $106,000 that you're seeing is the actual premium savings, assuming that you wouldn't have any losses. But because you're increasing your retention, right, now if there's $150,000 of losses, you're going to be on the hook for that additional $50,000 because of the increased retention. That $54,000 number takes that into account.
And it's from an actuarial perspective, by the way, because we basically estimate the losses for the change in deductible. So when you move from $100,000 to $250,000, there's an exposure between that layer on average that is calculated actuarially. So that is basically what we're providing you as feedback, because technically what the actuarial model provides you, it's a level of certainty with respect to performance in the future. Because you have a potential number of claims that happen within a given year that have different amounts. So we have to basically create 50,000 simulations, and those simulations are going to tell us what is the value at risk between the $100,000 deductible and the $250,000, and then that is how we also calculate how much premium credit you should also receive from the marketplace by getting that increased retention.
So you're talking the difference between a cash basis and what you're doing for an actuarial estimate, and that's what the difference is.
Exactly.
So when I go back to the cash basis, which is how we base everything. So if we save $100,000 and we now have a $250,000 deductible, then we would end up with one claim, we would be minus $150,000. Unless we have, because like just one claim at $250,000 is going to, it's going to cost the city money. And that's if we have one claim. If we have multiple claims, then it's going to cost us even more. So this, I'm just talking cash basis. But I guess my question to you would be, so you've looked at, I know you, in the report, it talks about a reciprocal, and you've talked about a reciprocal, but you also spoke about cooperative type purchasing with other municipalities, and that way we could get better pricing. And that is another option that we could explore in the future. And I like that idea because I've seen that happen in region of Waterloo. The municipalities there have all done a cooperative purchasing model, and they get substantially lower rates in their insurance industry. And I think it is something that we should be looking forward. And they certainly do not entertain even $100,000 deductible. Their deductibles are lower than that. They're about $50,000. So if there's one claim, then it doesn't end up costing the city so much money that we end up in a deficit position with, just one claim. So I would like to see, or like to know from staff, if we will be looking at that model, if we will be looking at a cooperative review, if there's any other municipalities in the area that would be interested in going into something like that with us.
Yeah, at this point, our risk management plan has us looking into the actuarial analysis as we did for GL and E&O, and then the next was property evaluation. So this isn't, cooperative buying isn't currently in our risk management plan. I haven't had a discussion with our manager of purchasing here on investigating that. So we'd have to get back to you on if what that would entail. We haven't explored that avenue yet.
I do have some information. I can give you some contacts of, like I said, with the region of Waterloo and what they've gone through, because they had they had all individual insurance policies. About 10 years ago, they came together and started cooperative purchasing, and it was actually a better method of saving money rather than increasing the deductible. It's just like I said, if you have one claim, you end up and that just kind of blows your budget for the year.
Thank you. You have a question?
Yes, through the council or through the chair. Last time we had the meeting, we were talking about the preventive nature. I asked a question about that regarding within this project. Me and Councillor Quinte went back and forth about it, and he brought that up again. Our city has done a bunch of things, especially if we're talking about the waterworks, because that's the example that you guys brought forward as a major critical loss. So as the only example that was brought forward, and in something that our city has put a lot of money, a lot of value in our water program, we have put tons of money in it and brought it up to a high level where the risk of an incident is actually lowered. In that, you guys said in this project, there's nobody who is doing the preventive nature, telling us what we can do to lower our risk threshold. And at this point, from what I see, $15,000 or $15 million, $16 million is what something if we had a critical thing. But at this point, we're looking at $50 million. On top of that, we have a one investment that last time we talked was about $34 million. So we do have a cash threshold if an incident happened. I don't know the actual method to take that money and put it into our emergency funding. But the only thing that you bring forward is bring up a deductible, which is, I'm not an insurance guy, not like Councillor Quinte. I know that's a thing that can reduce my money. If I bring my deductible up, my insurance goes down every monthly. Is there any other options that you guys have given us, such as reducing, even taking one of these $20 million off? So we still have $30 million in the event, which we can take 2,000-year loss scenarios and cover them within this portfolio. Plus, we still have that sitting in another $34 million sitting in investments that we're just accruing and just having there as well, obviously, like I said, I don't know how that money can be changed over. So in our case, we have funds on hand, we have cash, we have invested in an area that you said could be one of these critical things where we would have to put out a bunch of money. Have you guys estimated what our savings would be if we reduced this excess policy down?
So let me answer your questions. So I'll start with looking at it from a risk control perspective. So what it means to have dealt with the water treatment plant the way that you have, and how that shows up in the actual numbers, and then what it means to change your limit of insurance. So on the first part, that was taken into account in how the likelihood of a catastrophic event materializing would look like. So as you pointed out, a 1 in 1,000 year loss is only at 16 million. We don't consider that $15 million loss as being particularly likely, right? That situation from happening is a very, very low likelihood event because of all the control measures that have been put in place. It doesn't mean it's impossible, but it is true that there's a very, very low chance of that materializing. And that's why it has such a low likelihood of event. Now, there's other events that could trigger that kind of loss, but again, very low likelihood events. So for example, a very severe bus crash because of poor road design that lead to paralysis of multiple individuals could get to that sort of pricing. However, again, very rare, very unlikely. So the major element here on that point is that those measures were taken into account in how the likelihood of a worst case scenario was measured. And that's why, again, we consider your current insurance structure to be quite conservative in that sense. So from an actuarial perspective. Now, from a dollars in, dollars out perspective, that second $20 million layer that you're discussing on removing, I believe, if I recall correctly, is priced at about $30,000. So you're currently paying $30,000 on an annual basis to receive a potential $20 million of risk capital in the case of an event. So there could be a decrease in your premium on an annual basis of $30,000 if you were to get rid of that excess policy. However, you would be losing out on potentially $20 million of easily priced collateral or of easily available financial capital, to pay for that loss. And given the expected value, even with the very, very low likelihood, that $20 million loss is so significant that we still consider that layer to be fairly priced. That being said, if given the investments in risk control that you feel comfortable in retaining that $20 million layer of capacity, that can be an acceptable decision for the city on its own behalf. However, our recommendation is, given you're getting such a good price in the market, that the risk capital value, getting access to that $20 million, is worth more than that $30,000 of savings on an annual basis, which again is a third of that 100,000 premium credit that you're getting from going from 100K to 250K deductible. So just from a value for money perspective, we find there to be more value in increasing the deductible than reducing your limit of insurance.
Thank you.
Any other questions? I have one more. In my experience with deductibles, I have different deductibles for different items. For building, for example, or liability, or vehicles. Is it $250 over all the items, or just liability and building?
So in this case, that 250K deductible, I believe, refers, so in this case again, we're only talking about the general liability and errors and omissions. So this would only look at those kinds of losses. This doesn't modify your limit on your property. This doesn't modify on your own vehicles, so your auto policy. Those are not affected by this change in deductible. That being said, sometimes an insurance policy will have specific sublimits or sub-deductibles based on specific types of coverages within an insurance policy. So I don't want to, again, discuss too much on the specifics of your specific insurance policy in that sense. However, your general deductible that applies to most losses, in this case, would go up to $250,000.
Great, thank you. Any other questions? Thank you very much for your presentation and your explanations. Oh, sorry, you have more.
There are other slides that we can
go right ahead.
through
Yep.
as well. However, we've covered most of it, so I'm going to run through it quickly. But I think in the question process, we actually picked up on a lot of the answers that are in the rest of the document. So, for example, in this case, the liquid effluent discharge system failure was the worst case example we used for industry losses we discussed. Overall, again, historically, Quinte West has very, very good performance. Which is a good sign. Again, we use actuarial numbers. Their historical performance would actually indicate that you would make even more money or save more cost of risk by increasing your deductible, because your historical performance has actually been better than what the actuarial model would predict. Assuming, again, your historical performance continues. And then when looking at the main sources of risk, I think these were presented in April or May. But the source of risks remain snow and sidewalk and roads to be the main types of general liability losses that we would expect for your organization.
We're in no rush,
looking
take
at-
your time.
Oh, no worries. But these are the major points in this place. And again, as we mentioned, the liquid effluent discharge system is in place, and so we took that into account when we were timing or looking at the likelihood of that sort of failure and what that would mean for the organization. From an actuarial analysis perspective, again, on the 3 points that we talked about, limit adequacy, adequate but conservative, but you're getting a very good price in the insurance market, so we recommend keeping it. Technical pricing, you have the renewal premium of $561,000 is lower than the actuarial premium, indicating you have a good price in the market. But that again, a lot of that benefit is at the excess layer, and that your primary policy is considered to be fair. Slightly, again, you are getting a good price at the primary layer, but it's mostly on the fair area. And then from a retention perspective, your deductible is considered to be low. You're retaining less of the risk exposure than you could, and there is a potential value in increasing your deductible to $250,000 to reduce your cost of risk. But again, this is me repeating myself to some degree. And so again, we were talking earlier about looking at the numbers. These are the numbers. So when you're comparing the different options, we look at 4 things. So what are the retained losses in the deductible and how do they change by increasing your deductible? What is the loss pick for your primary limit of insurance? So how many losses do you expect to be covered by your primary limit of insurance? How many losses are we looking at increasing with the retention? So at a $250K deductible, for example, you're on average going to be retaining an additional $55,000 of losses. And then what that break-even primary premium would be. So what price would they have to charge you in the market for you going to the $250K deductible to be risk neutral, so that you'd still be paying the same amount between premiums and retained losses. And that amount was estimated at $405,000. So given the fact that the market is actually only going to charge you $351,000 for that $250K deductible, we see that as $54,000 of annual savings, taking into account the increased losses. If you're just looking again at the difference between the current premium and the renewal premium, and assuming that your performance continues to be excellent as it has been historically, you would actually be saving closer to $100,000 a year on an annual basis. We also included the numbers for a $500K deductible if you have a higher risk appetite than we expect. That being said, in general, we recommend for these deductible increases to be done slowly and manageably. But if you wanted to go directly to the $500K deductible, we consider that to bring in $84,000 of saving on an annual basis. So these are the hard numbers that we're looking at. And then finally, the point that was made earlier on, okay, well, if we have $250,000 of losses, all that premium credit is taken away. And that's true, but the actuarial model would suggest that, again, that sort of event would certainly not happen on an annual basis. And so annually, in the long run, even though 1 year you may have a negative performance, in the long run, on average, you're going to be saving more money for Quinte West than you would if you retained the current deductible limit. And this is indicated here when we look at not only the potential premium credits, but we look at the increase in volatility. So when looking at the increased volatility, that sort of $250K loss would likely be seen somewhere, I guess, in the 80th percentile. So 1 year out of 5, you'd maybe expect that experience. But in the short run, certainly would not happen every year. And on average, again, you would be saving money. Keeping in mind, again, these are actuarial numbers. Your historical performance has been better than that. And so we can expect a better performance than that moving forward, assuming that the trend continues.
And generally speaking, these numbers can also be leveraged to create a reserve internally to understand basically what is the expected performance on an annual basis and the claims that you would be retaining via that deductible. And obviously, like generally speaking, what we suggest to clients is like once you actually get those premium savings from the market by retaining more risk, use those credits to actually create yourself a reserve for the expected losses within the next year. And then you accumulate that surplus so that you can basically then either also channel the money towards like something that is more oriented towards risk improvement, increase financial capacity to retain risk, so on and so forth. So there's different options that you would also like accumulate over time. But from a budgetary perspective, it allows you also to look at what is the amount of risk that I'm actually taking and how do I manage that or finance that risk within my balance sheet so that I have money to actually pay for expected claims in the future.
And something that would be beneficial is we've already had that conversation with your staff, and I do believe that that process is already in place to use these numbers to inform the reserving piece in the budget.
Councillor Quinte, did
I
you
don't know
have
if
a
there's any
question
other
you
questions.
wanted to ask?
And when they're done, when they're all finished.
Okay.
We're completed on our end from that perspective. We just have questions.
Yeah. I just want to point out every time you mention about saving money, you're talking about saving insurance premiums, which would be a savings for taxpayers. However, from our point of view, if we are going to take a bigger deductible, that may mean that we may have to make some adjustments to our staffing levels, our budgeting levels. So it's a bigger decision than just saving $54,000 or $96,000, whatever the actual number ends up being, to see how that's all going to really play out. So we'll be talking with our staff later on when their staff report comes in front of us. So thank you.
Perfect. If there's not any other questions, thank you for your time. I also did want to take the time to thank Caleb, Mellon, and Lisa for all the work that they've done. They did a lot of management of the data on their end to make sure that we had good inputs going in and so that the output would be good. So I did want to take the opportunity to thank them for their help on that. And again, there are more of these coming your way in the future. So hope to speak again.
Thank you. Thank you for your report, and I found it to be very easy to understand, which I appreciate. Thank you.
Me
Thank
too.
you. Have a great day, everyone.
Thank you.
Next, is there any correspondence? Seeing no correspondence. The next is staff report regarding the 2024 audit plan from Matt Hodge, Minister of Finance. The resolution is that the committee received the 2024 audit plan and engagement letter as information. Someone like to make that motion? Councillor McHugh? Seconded for Councillor Siddell. All in favor? Thank you, passed. The next is staff report 24025 from Melly Monsieur, Manager of Purchasing and Risk. The resolution, committee receives a 2025 insurance renewal update and overview of the 2024 insurance risk and management as information. Someone like to make, Councillor McHugh? Seconded by
Somebody down there.
Mr. Browley. Are there any questions on this?
Maybe one or two.
Mr. Stafford? Or Sanford, sorry.
Is kind of a question to do with the actuary stuff. Is this the right time?
Sure.
Yeah. The one thing that I'm seeing with this, we're talking about insurance, and Councillor Quinte has pointed out the last two meetings, just like me, is we're talking about actual things, actual people, actual buildings. And we have the actuaries telling us about the numbers with regards to the insurance. But do we have a risk policy within ours that we can look at, such as $50 million? Do we need the $50 million at this point? I know it's $30,000, but we're obviously paying these people some sort of funds to do what they're doing, and they're coming back with $54,000. And I don't care either way. I'm a citizen. I believe we have professionals here that have the knowledge and the ability to make those judgments. If I can help, I'll help. But is there any way that we can create some sort of risk to look at the risk on us, on our actual assets that we've been talking about? How can we improve these to lower our risk? So maybe not this year, maybe not next year, but in future years, we can rely less on insurance. So we don't need $50 million. So we can slowly chip away. If we're looking at saving $54 million or $50,000 this year, there's $30,000 we can easily nix. That, yes, one day may hit and we may need to pay it, but as they're saying, that could be 1,000 years. It could be next year, or it could be, but it's $20 million, we have that aside. So that's my thing, is I'm feeling there's a lack of our response to the risk and how we're going to mitigate actual risk, not just play with the actuaries to figure out how we can save on repairing the risk afterwards, and if that's something we want to look into. And that's just me as a citizen and someone with this committee, if that's something available.
Yes, I could speak to that through your chair. Certainly, we can undertake an investigation internally to sort of assess our committee and our council's appetite for risk compared to having this actuarial analysis has really given us something to sink our teeth into exploring these areas. So looking at that, looking at the appetite, looking at what are we actually doing, like piggybacking on what we do have with our current risk plan annually to get us a better analysis that might be better to inform the committee.
Sounds great, thank you.
Any other questions?
I just have a comment. So, risk, I always think of risk as a multi-layered issue, and I've had this discussion with Director Denowden, whereas, yes, we have insurance, but we also have our staff. We maintain our own buildings. We have alarm systems. We have video cameras. We have our own public works facility to service our own vehicles. We have, as best as we can make it, our wastewater treatment plant, which we have plans to continue working away at improving the efficiency of the wastewater treatment plant. And we have more than one wastewater treatment plant. We have multiple wastewater treatment plants that have all met every criteria that we've tested them up against, which is part of our system. We've invested in our IT system, our computer systems, training for our staff to, assist with how to defend the city of Quinte West if we're under some kind of cyber attack or errant email. It happens all the time. I just completed a quiz just myself on my cyber knowledge. I don't know if I passed or not. I can't remember. I must have. Otherwise, I probably would have got kicked off. But so we, as our committee and the council, we just need to know when we're talking about risk, what other defenses do we have against risk besides just relying on our insurance policy? There's multifacets to it, and that's how I look at things. Thanks.
Thank you. Any other questions?
Just one more in regards to the deductible. Is that in this report too? Is that where we're talking about our deductible? Or is that in the next report?
This report. Through chair, it is in this report.
So, what expenses might the city incur if we were to increase our deductibles? Because that could mean that there's a high degree, I guess, that there's going to be more work. And if there's more work, do we need more staff? Do we need more economic resources? Do we need more systems? Does our claims service that we're using, I'm sorry, I don't remember the name of the contractor we're using for claim service, are they going to have to do more work? And do they have enough staff to help us out if that's the route we're going to go? Because there's more to it than just saving a few bucks.
Yes, that's something that's been in discussion amongst staff for this past year, and looking at the actuarial analysis and based on our current loss history, what we would anticipate to have to deal with, that staff would have to deal with in terms of managing. We feel we're able to undertake for the next year or so, something to, into the next year, consider how it is affecting staff, but at this point, we feel it's manageable.
Mr. Chair.
Councillor Siddell?
So just to be clear, our whole path forward on this is that we've now had the actuarial look at, a couple of our pieces of insurance, and they're going to continue to look at the rest of our insurance. And they're going to make recommendations on each of them, and then when we get to the end of it, then there'll be a full recommendation that will come back from staff as to what we're actually going to. At this point, they're talking $250,000 deductible, but we're not going there right away. Like, this is not approving that.
Through you, Chair, we were, in the report, if we want to take advantage of that $109,000 savings, for just this line, the general liability and the E&O line, we would be able to move forward to increase our deductible to $250. But again, that's at committee's recommendation here.
Okay, that to me was not clear. That's not clear in the recommendation. The recommendation to me is to receive the report as written. I would say that I'm not sure if we took this to council, council would want to know exactly what we were doing with the $250,000. We'd want that actually in the resolution if we were going to change that deductible up to $250. So I can't support it if that's what the recommendation is at this point. I'd prefer to wait until we get all of our information back and then look at a whole package with a detailed recommendation to council.
Director Denowden, would you like to comment on that?
Yeah, if I could just clarify, so the renewal package is in here, and we only we asked them for different rates on the renewal for the GNL side because we had done the actuarial analysis, and historically we've increased from 25 to 50 to 100 over the last 5 or 6 years, and we wanted to know from BFL if it made sense for us to go to 250 to retain a higher amount. They've come back and recommended it, and so we are happy if the advisory committee were to recommend, we think this makes sense financially, to recommend the 250 for the E&O and GNL side. The other pieces, property and that, will come back in a year when we do that actuarial analysis to see what kind of changes we can make on those policies if they're financially prudent. So yeah, we would recommend to council to move to the 250, and in our budgeting, just to be clear, so we budget for the premium, and then we also budget for claims deductibles. So we already have. Do you have an amount, Manager Mazur?
I think they're budgeting about $850,000 in reserves at the end of the year for insurance.
Yeah,
That's correct.
thank you. So yeah, so we have the reserves. We also have an annual amount. So if we're under or over the amount, we either put money into the reserves or take money out of the reserves. And so if we did have a lower premium, we may have higher deductibles. Or we may have to dip into the reserves. But again, the lower premiums mean we have more money to put into the reserves. So it would balance itself out. And as the presenters mentioned, that total cost of risk net, we should save $50,000. We're not suggesting changing the budget at this point. Maybe next budget cycle, we can recognize where we think the deductible amount should be. But at this point, the budget wouldn't change, but it looks like the total cost of risk would be lower for the city to make that change.
Can I follow up, just to clarify?
Absolutely.
So the amount that was approved in the 2025 budget included the amount for the renewal with the $250,000 deductible? No. It did not. So if we didn't change the deductible at this time, then we're within our budget?
Yes, so if we didn't change it, we're within our budget, and if we changed it, we would technically be $50,000 in the black
Okay.
because of that change.
Just trying to-
I believe we budgeted 8%, and the increase is only, with the current deductible, 5.89%, so we'd be to the good.
Okay, thank you.
Councillor McHugh.
Yeah, thank you. Councillor Quinte brought up a point that's got me thinking here. We're going to say we go to $250,000 deductible, we save $54,000 roughly at the end of the day. How much of that $54,000 is going to be spent on the extra claims work that's coming in? Are we really going to be saving any money? I know Councillor Quinte is in this business, and it never occurred to me, thinking at $100,000 we deal with it, and anything over that we turn over to the insurance company. Now we're going to deal with all the claims up to $250,000. If we get 10 or 15 claims, how much of that $54,000 going to be left? Are we Are we robbing Peter to pay Paul here? Are we getting ahead of the game at all here?
So just to be clear, that, yeah, the number of claims doesn't change. We still have an adjusting service. I like to kind of analogous to the inflation, right? 10 years ago, we lost a vehicle, it was worth 30,000, and now today we lose a vehicle, it's worth 60,000. So some of the claims are just the same claim, same amount of work, just a higher dollar value, right? So there's that inflationary piece. And then in terms of managing the claims, we already do manage a lot of these claims, sometimes jointly with the insurance company, depending on what we project the value to be. But we're talking less than 50 claims a year in total in aggregate. And of that, only a portion that would be, we would think that would go to the deductible. So we're talking about a handful of claims. And yes, we believe we have the staffing resources currently, not requiring additional staffing resources or other resources to manage that difference in deductible.
Councillor Quinte?
I've been giving this some thought about the deductible, and I am in favor of going with the $250,000 deductible, but I wanted to hear from staff about our claim service. And then also one clarification, I guess. When we're talking about claims, we're talking about when there are incidents, they get called in and reported to us, we deal with them as a claim, but not all of these claims go to our own insurance company. That, like these numbers on here that we're stating are claims, not necessarily are they all going to our actual insurance company. So we may not even contact our insurance company, say if it's a vehicle incident and we know it's going to be $25,000, like we're not even going to phone our own insurance company. So how many, or what might the percentage be of incidents or claims that we actually go to our own insurance company when it comes to liability and errors and omissions? Do we know?
Through your chair, it's about 20%-ish, varying obviously from year to year, of claims that are out of value that we actually need to engage insurance. So right now, staff is managing claims that are within the threshold, under $100,000. I mean, there's rules we follow for that, but this would be raising that to 250.
And one other point for people to think about when it comes to this fun topic is all this work we're doing, this report that BFL is doing over the next, it's 3 years, I believe. If we do go to a $250,000 deductible, which I would support, it just makes it more appetizing for the underwriters out there actually underwriting the insurance to see the type of work that we're doing to invest in our risk appetite or our risk situation. Yes, we're going to have some claims, and of course, if we aren't even reporting most of them, then it's going to make a easier sell for our broker if we're using BFL at the time or whatever the story may be for the future. It just makes it a better appetite for the underwriters looking at our situation, because they look at hard facts. They don't come to our city to see our equipment, to see our services, to see our buildings and infrastructure. They rely on what the broker tells them, and if the broker tells them we're a good risk, then they're going to listen. And everybody needs the insurance, because if we didn't have insurance, I wouldn't be sitting here. So I'm gonna support the motion that we move to the $250,000 deductible. Thanks.
Thank you. Any other questions?
Can you please clarify, is the resolution on the floor and what the resolution is?
I believe it's to be received as information.
But if it's to be received as information, staff's indicating if we receive it, then we're approving the $250,000 deductible. and that's not clear in the resolution.
I apologize, it's not unclear on the resolution. The resolution, a recommendation should have had that in there, to be clear. So staff is recommending this. The current recommendation does not read the way it should. So if we can alter it and see if there is a motion to alter the recommendation to suggest council increase the deductible on
Who's the mover?
GNL
Who was the
for
mover?
250,000.
Who was the original mover?
I think it was Councillor McHugh, wasn't it?
Was Councillor McHugh.
I'll accept that, thank you, yes. I'll accept that recommendation. Thank you.
And the second,
Public member Steve Brawley.
would you like to
I'll
amend
second
it? Yeah, he's willing to amend it too. Thank you. Yes, Councillor Siddell.
Just a further comment, I won't be supporting the resolution. I feel that we don't have enough information at this point in time. We have more of our insurance policy, and I'm not prepared to take the risk to go to the 250. I think we do have to do a little bit more review of staffing considerations as well as the rest of our policy before we move forward with this type of a steep increase in our deductible.
Any other questions? Question for Director Denowden. The current insurance reserve we have right now, roughly projected to be 800,000, is that from just the savings and premiums from increasing the deductibles? Is that the only thing that's created that reserve?
Good question. Lower claims, I think it's also part of that as well. So we've seen good practices for risk management. So we've seen lower claims than what we've had historically. If you look at in the last 10 years, it seems like the trend is going down, which is really interesting trend, which has allowed us to put some of that money into reserves. But you're also right that over the last 6 years or so, we've been increasing the deductible, which has also allowed us to put more money into reserves.
Thank you. Any other questions or comments before we take a vote?
Can I just clarify? So the motion is that the committee receives the 2025 insurance renewal update and recommends to council to increase the deductible to 250,000, and further that the committee receives the overview of 2024 insurance and risk management as information.
I believe that's correct. Okay. All those in favor? Passed. Thank you. Sorry. Staff report 24026 FIN from Melanie Masseur. Purchasing policy updates the resolution purchasing policy updates be received. Moved by Councillor Quinte, seconded by Councillor McHugh. Any questions or comments?
Mr. Chair.
Councillor Stedall.
Councillor Steno.
So just to clarify, we're increasing the requirement for 3 written quotes from $40,000 up to $100,000. And what was that number before?
That maximum threshold before was 75,000.
Okay. And just to be clear as well, this is consistent with other municipalities, and this is
Yes, we did do a survey, and multiple municipalities, County Northumberland, County Hastings, City of Belleville, other comparable cities are at the $100,000 threshold.
I have a question.
Councillor Quinte, do you have a question?
Is this the section where we were talking about purchasing cards or credit cards? Is this in this report as well?
Through you, Chair, the request for the updates do not include any changes to the purchasing card policy.
Did I read that's in maybe one of the later reports then?
I did it, through you, Chair, I did attach the entire purchasing policy, which does include a section on the purchasing card. There's just no changes at this time requested.
So, out of curiosity, because I really don't know, like how many cards does the city have? How many do we issue? Because I don't have one, but Anybody here in this room have a card for purchasing?
I got two.
Through you, Chair, I'd have to get an exact number for you, but I think we're definitely multiple dozens that like into the probably above 80 staff have purchasing cards.
Okay. I was just curious, thanks.
I was kind of confused. When we get monthly reports on the purchasing, and it just says P-card purchases, but are there multiple amounts over $10,000, $100,000? It just gives one total, and it doesn't give any breakout of anything.
Yeah, so the over 10,000, you're seeing the payment of the P card. Within that, it's generally small purchases. If it was over any of these thresholds, I believe it would be displayed separately. Is that right?
Staff, if they're using a P card, if they're able to purchase at a higher level, still have to follow the thresholds, the authorization spending thresholds that are outlined here. And if something was non-compliant, or it would be in our quarterly report that you see come to council as a non-standard purchase. And if they wanted to purchase something, for example, over 100,000, if there was that buying power, it would have to have been acquired through our proper process, for example, or quotes gathered in those thresholds.
But I'm asking on the P-card purchases, if it was $100,000, are we going to see $300,000 P-card purchases, but not this $100,000 purchase? Shown separately.
It's a good point. There could be, I'm just trying to think if any of our credit cards have a limit where we're, say, paying for software that's over 10,000 for one transaction. It may be within the U.S. bank transaction.
Yeah, through your chair, currently no cards have any buying power of over 75,000 or 100,000. In theory, we could organize that, but right now, no one has that set limit.
It's 10. The report, I think, Councilor O'Neill has talked about is over 10,000, right? And so there could be purchases between 10 and 70, or that would be embedded in there. It's a good point. We could take that away and see if we can break that out a bit better if that happens.
That would be appreciated. Thank you. Councillor Siddell.
Thank you, Mr. Chair. Two questions. One I'll ask just because people always ask me this question. Is there any members of council that have P cards?
So through you, Chair, I believe the mayor has a purchasing card, and I don't believe that any of the other councillors have a purchasing card.
Okay, thank you. And my second question is, it talks about items that are deemed surplus from the city shall be disposed of by first offering them to other departments, and if not required, shall be disposed of in a most suitable manner. And I know there's, different items have different way that you can dispose, but does the city use Gov Deals?
Yes, we use Gov Deals, and we also use Brian's Auctions primarily for vehicles. They have an online public auction option, and we do, to answer your question directly, we use Gov Deals frequently to dispose of surplus items and get the last bit of value out of them that we can.
Okay, thank you.
Thank you. Any other questions, or can we take a vote on this? No other questions? All in favor? Passed. Thank you. Next is staff report 24027 FIN from Melanie Masseur regarding risk management policy and procedures 2025 risk management plan. The resolution that committee recommends that council approve the proposed 2025 risk management plan. Someone like to make that motion? Councillor McHugh? Seconding?
Awesome.
Mr. Stafford? Sanford?
Somebody wants to get this on the floor to talk about.
Sorry, I'll get it.
We should have more meetings.
Any questions or comments on this?
I just want to say, I like the idea that we're working with our broker and coming to a plan where they're really assisting us with our insurance, and the report that they're going to be working on next year and the year after, is that sort of worked into our risk management plan that we're talking about here right now?
Through you, Chair, I think there's some items on there certainly informed by that in terms of looking at a potential insurance committee to deal with our claims decisions and just managing this deductible. And I think as we move forward, this is the first phase of the report. There's more and more coming to for us to really sink our teeth into this in-depth analysis. So I think you're going to see more and more direct connection on our plan annually.
So staff are looking for a separate committee from this committee to talk about insurance matters.
Through you, Chair, yes. We're looking at the possibility of a staff-based consultation group just to assess if there's a complex claim decision to be made.
Do we have an idea of like what were you thinking in terms of, like, is it going to be 22 people or is it just senior management? Like, what are you talking about?
Through the chair, just to maybe clear, the committee might be the wrong term. Right now, it's quite informal as we're growing in our risk management process. If an adjusting service provides us a recommendation, we usually take that back to, let's say, the director or manager involved in that. If there was claim in the building department or claim in the public works department, we'd take those parties as well as the director of finance, myself, and the insurance team, and try to make a decision whether we do pay that claim out or we hire a lawyer and maybe fight it a bit, or we agree or disagree with some of the details of the adjusting services report. And all of these would be under the value of the deductible, or actually 50% of the deductible. Anything over that, we're immediately dealing with our broker or insurance company. So it's just a matter of formalizing that process, which has been kind of informal to this point.
So then by us going to a $250,000 deductible, if that's the direction council ends up going, then this is going to take some more staff time. You don't need any new staff members, but it is going to take more time to deal with these issues. Is that what you're foreseeing?
That's correct. So when we were saying before about 20% of our 50 claims, so up to 10 of these cases. Before we were dealing with 40 or 30 to 40 of the cases internally because they were under the threshold. Now 5 to 10 more cases will be on our plate to make decisions about. So yes, it will be additional time, but I would say not a significant change.
Okay, thanks.
Councillor Siddell.
So just following what Councillor Quinte was talking about in regards to additional staff time, et cetera, and the size of our municipality, the cooperative that's in the region of Waterloo and also with the region of Durham, they also have one as well. They have staff that are identified that they pull in to, so they have, I think, 5 people at the region of Waterloo that deal with all of the claims that go through them, and they have a population of 695,000, so they're huge. And they get the savings in their insurance, but they also have this separate insurance department that reviews all of the different claims, and it pulls all of this information in. So I think, I see what we're doing here now, and we're starting to go in that, but it does take a lot of staff time, as Councillor Quinte just suggested, and if we could go to a model where we have some of our other neighboring municipalities that are involved with it as well, we might find that it actually saves us a lot of money and a lot of staff time, but we get a really good result out of it. So hopefully, supportive of what we've got here today, but I think going forward, we really need to look at the bigger picture to see if we can get some savings for the city.
Thank you.
One more follow-up question, if I could.
Okay.
Do we have a staff member who is either completed some insurance training courses or already completed insurance training courses? And if not, I would encourage us to find somebody who would take some insurance courses or maybe work their way to some sort of underwriting degree or a CIP program or that sort of level of insurance, so that we have somebody that we can lean on for real opinions, I guess, from real training.
Through your chair, I can respond to that. Both our insurance coordinator, Lisa Brooker, and myself are currently undertaking our Canadian Risk Management designation with courses, and I think we fully expect to be completed that next year.
That is excellent. Thank you.
Thank you. Any other questions, other than Councillor Quinte, who had his last one?
That was it.
All those in favor of the report? Pass, thank you. And Mr. Sanford, I apologize for missing your name. I used to call you by your first name. I see you volunteering at North Trenton School all the time, and I do appreciate that.
Just to respond, I'm ex-military. I've been called a lot of things in my life, and I'm not offended at all. And we'll work together to get that straightened out.
The next is staff report 24029 FIN from Matt Hodge, Minister of Finance, regarding the BMA municipal study. And the resolution is the committee received the following draft BMA Consulting Inc. benchmarking as information. Councillor McHugh moves it. Councillor Siddell seconds it. Any questions or comments? Oh. All those in favor? Passed. Thank you.
We've now been benchmarked.
The next is staff report 24029 FIN from Matt Hodge, Manager, Staff report 24030 FIN from Matt Hodge, Manager of Finance, regarding the 2023 financial information return, which the resolution that 2023 financial information received the FIR return. Moved by Councillor Siddell. Second, Mr. Brawley. Mr. Hodge, could you explain what the FI, or financial information return is for people in the audience and members of this committee, please?
Yeah, through your chair. You're right, it's the financial information return. So every year we complete our audited financial statements, and once we have our audited financial statements, we need to complete the financial information return to be filed with the province, I believe it's the province. So it is very similar to the financial statements. We use the financial statements as the basis. They just require a little bit more detail in some of their breakdowns of expenses and debt and reserves. So this provides a level that can be compared to all municipalities. Every municipality has to file this exact same return. There's some more data on stats and things like that that don't show up in a regular audited financial statement. And in the end, we get our annual debt repayment limit calculation from filing our FIR. And that's where we get the estimated debt limit that all municipalities have to abide by for the 25% of revenues.
Thank you. So it's more standardized reporting, so it makes it easier to compare to other municipalities too, right?
Correct.
And being at a government website, I tried to print it out or get on, and I couldn't do anything with it.
It is there on the website. Yes, it's the government websites are not always the easiest to navigate, but it is there. If you want a copy or need some assistance, just reach out to us and we can give you.
And the page you did print out on debt, would you like to comment on the city's debt compared to other municipalities for the committee?
Yes, the report prior mentioned our debt comparably to other municipalities, where we are on the higher end of debt and lower end of reserves. So that annual repayment limit that gets calculated every year from our financial information return, we are using 10 million out of the 25, so we still do have room, but we with all the capital projects that we have in place, we'll be climbing up our annual repayment limit before we start getting more room for new debt.
Thank you for your input.
Thanks.
Councillor Siddell.
Thank you, Mr. Chair. So kudos to staff to get the FIR done. I know it's getting close to the end of the year, but I think every other municipality in the province is following the same timeline. It's usually due in May, but nobody, it was already filed? Oh, okay, because,
Through your chair, yes, we filed it before the deadline of May, and normally we always do. This is just the next meeting that we've had since filing, just to give an update that we've filed it on time.
oh, okay, thank you. Because most municipalities in the province, there's a huge number that haven't, in fact, the deadline ended up being extended to December 31st because it's been so difficult a year with so many changes with the accounting regulations. But one thing I just wanted to make a note of is that, yes, the ministry site is different. It's a little bit more difficult, but I find the ministry site has got more specific details and easier to compare apples to apples if you're looking for a municipality that's comparable rather than the BMA study. The BMA study is actually a hired study. So in other words, municipalities pay into it and then that's the information that's delivered back. DFIR is a requirement for all 41 municipalities across the province. So any detail that's in there, if you can get into it, they've tried to make it a little bit easier to pull the information out, but it actually does, you can fine tune it and you can get better comparables for it. So, but kudos to staff. The only question I really had was there's another page that comes usually with the ARL, and that's the one that shows how much the borrowing would be based on, 20 years or 15 years and the 7%. I'm just wondering if that maybe could be circulated, or if, I guess we could just go onto the MMAH site. So this one just talks about what the total estimated annual repayment limit is, but it doesn't do the examples. That's what I'm talking about.
Through your chair, yes, I believe this is a page from our FIR, and then we get, in return, we'll get an ARL letter from them. In the future, we can share that letter with the committee as well.
Okay, thank you.
Thank you. Any other questions or comments?
Yeah,
Councillor
I have a
Quinte?
comment. In regards to our debt, I don't see, I get where we're going, so I don't see it as a problem. We are all, at this point in time, we're still well within the parameters that the province of Ontario has indicated. And we're getting work completed or planned to be completed. So I see it as an investment in our community. And maybe part of the reason, and I don't know if it's true or not, maybe part of the reason is other municipalities are not willing or not able to or not proceeding with some projects that they need to do. And so we don't see that measured in the chart if they are holding off on doing projects that they know they have to do, but they're not ready to do them yet. So I see that we've got some great things that we've invested in the past, and once they are paid for, just an example, our public works facility that we invested in, once that paid for, like that structure should last 100+ years, and it takes us 25, 30 years to pay for it. It's no different than somebody owning a house. I'm not saying that everybody, but in my wife's and I case, we bought our home in 1987 and now it's finally paid for and we're enjoying the benefits of having it all paid for. But no, I get that other people, they move around, they change jobs, they get a bigger house or a smaller house and up and down and all that sort of stuff. But as a municipality, once our investment into our structure gets paid for, then that's going to free up revenues to do other things or purchase other equipment, and our asset management plan is pointing us in that direction. That like there's no end to the list of things that we're going to have on that asset management plan. We just, in some cases, we're just going to have to be patient when we go to start something in 5 to 10 years from now, and I won't be on council then, so that'll be up to the next council. Thanks.
Thank you, Councillor Quincy. I partially agree with you. There is good debt, but as a small business owner, the more debt you have, the less flexibility you have. So,
Very true.
thank you. Any other questions or comments? All those in favor? Thank you, passed. The next is staff report 24031 FIM from Caleb Denowden, Director of Finance. Resolution, council approved the 2024 investment policy statement as presented as part of the annual review. Would you like to comment on this too, please?
Yeah, thank you, Chair. So this, our investment policy annually is due for update. This year there are, I think last year there weren't any updates. This year there's, the main update is regarding the new framework. So our investments are moving, staying with LAS One Investment, but they're moving to a new program that's called the OCIO. And so really the policy was, the only changes you'll see in the policy are regarding the new investment framework. We're expecting that the funds will be moved in about March to that new framework. And this is basically, we were one of the first 7 municipalities in this fund, and as more municipalities come on board, they're, I guess, tightening the rules. They're creating a better system for investing, and basically OCIO stands for Outsourced Chief Investment Officer. So I don't make the investment decisions; those are done by our outsourced Chief Investment Officer. So really, no significant changes, but yeah, that's the only change to our policy at this point.
Thank you. I personally, when we started, there were reports I wasn't a fan of. I feel they've improved dramatically, and I'm glad you helped with them do that. Thank you. Any other questions? Councillor Quincy.
I wanted to agree with you that you have brought up some excellent points, and Director Denowden has taken those points and poked them, and they did something about it. So I agree. Thank you very much for your insight and your long-range thinking on that. Thanks.
Is he talking to me?
Yes.
Oh,
Yes,
thank you.
specifically talking to you,
Got a door big enough
Chair
to get here tonight?
O'Neill. It was awesome. Thanks.
Thank you. All those in favor of the report? Oh, sorry.
We don't have a mover or a
Oh,
seconder.
I'm sorry. Councillor McHugh and seconded by Mr. Sanford. Thank you. All those in favor? Pass, thank you. Any new other business? I don't see any, thank you.
No,
Oh, announcements?
do that?
It's not here, but I'll let you do that.
Thank you very much. 'Tis the season, so as we did the other night at council, I don't get to see all of you folks all the time, so I want to wish you all a very Merry Christmas, a Happy New Year, Happy Hanukkah, however you celebrate it, get out there, enjoy your families, and be safe. Thank you.
Thank you. Any other? No? Move for adjournment. Councillor Quincy, seconded by Mr. Browley. All those in favor? Pass. Thank you.